Evening all. It's just gone 6 o'clock, so we're going to kick off on time. So thank you everyone for joining us. You've got myself, Jolene Stockwell, you've got John Cheney, we're both from the Perth office, and we've also got Justin Colley, who's sitting by with our chat function, joining us from over east this evening. So thank you very much. We're doing a retirement seminar this evening, so we'll be looking at things to help you prepare and what you should look out for. First of all, we'd like to thank and acknowledge the traditional custodians of the land in which we work and live, and recognise their continuing connection to the land, water and community. We pay respect to elders past, present and emerging. And all the tiny fine print this evening will be factual and general only, so it is not particular to your personal circumstances and your situation, so please don't act on any of the information you get until you ascertain whether it's suitable for yourself or not. You will notice on your screen that there is a chat function. Justin is monitoring it, so he will be looking at questions, and we'll be looking at having a bit of a question session at the end as well. So please, if you do think of anything, please put it in there and let us know so we can help you with your answers. So retirement, what does it mean for yourself? What are you looking forward to doing? Cruising's taken a little bit of a hit of late. Used to be a lot more popular than it is, but everybody's got a wee bit of a different idea about how they're going to spend their time. Okay, so the first step in preparing for your retirement is thinking about what is important to you and what you want to spend your time and your money doing. When you do get to retirement, we're going to have a look at a few standards about retirement. So what is comfortable, so you can try and get a little bit of a feel of where you might want to be aiming for or where you might want to be sitting. So full age pension is not a lot. Okay, single person 25,000, a couple almost 38. Okay, but it doesn't leave a lot of wriggle room if things go bad, or if your car breaks down, any kind of small thing, the age pension doesn't help very much. A modest lifestyle, okay, so a little bit more than that, and then you've got a little bit more flexibility with that, and we're going to go into a little bit more detail about what is modest and what is comfortable and what that actually entails, so you can get a feel for, okay, if this is what a standard modest lifestyle is, am I more or less than that? Am I more or less than the comfortable lifestyle? Now, we are also going into a bit more detail later on Centrelink, so we're not doing too much on it now, but we are going back to it in more detail, and we do have Centrelink seminars coming up at some point in the future, so keep an eye out for those as well. So this is looking at what you can expect to do for those figures. Okay, if you are on the age pension, you are having a car, but repairs are going to really stretch the budget. You may eat out occasionally. You'll be at home a fair bit. You're not going to be overly social and going out. And you may have to make choices between heating and cooling in summer, depending on the bills. In the middle, you're looking at if something goes wrong, if the car breaks down or a washing machine breaks down, then you might have to save and budget for a little bit to repair those things. So you're going to look at repairing first rather than replacing. Okay, and you might be a little bit more social. You might have private health insurance, but there's not going to be a lot of traveling or any of those nice extra things. Comfortable lifestyle. Obviously, this is the most popular. This is where people want to try and head, because this means that you've got private health insurance. It means that if the fridge breaks down, well, you can afford to replace it. It means that you can go out with your friends and your family and celebrate birthdays and events. And it means that you can be social on a regular basis, and also you've got an annual holiday at least. So that gives you an idea of what's affordable on each of those lifestyles. So I'll just go back briefly and have a look at those numbers. So that's what you should expect. Now, that income, what it's made up of, is going to be a few different things. So we'll look at the combination of super and age pension later as well. But what we want you to do is take a holistic view. Don't just look at super, don't just look at age pension, but also look at everything that you've got going on, all the opportunities you've got, whether it's cash savings in the bank, the family home, if you've got more outside of super, so shares or property that you own directly outside of super. We want you to have a look at things all together on top of your super. So obviously tonight we're going to do a little bit of a focus on how you can use your super. So John, if you wouldn't mind, away you go.
Thank you, Jolene. So the tax benefit of saving with super, there are really two main reasons why we have superannuation and why it's beneficial to us. One is that there is growth in superannuation assets, and the other major benefit is the tax. So on this slide, we can see that in super, the tax on investment earnings is only 15%. Now, 15% is good because if you had investments outside of super and were to cash in your profits from that, that would be at your marginal tax rate. So 15% is a really good figure. That also applies to the transition to retirement pensions, and we'll talk about them later. And then it gets really exciting when you get to the point of having an account-based pension, because then there is no tax on investment earnings, and we'll talk about that also a little bit later. So when can we start accessing our superannuation, and at what ages? So we have three buckets here. The first one, age 58 to 59, second one, 60 to 64, and the third one, 65 plus. So you may be under the age of 60 now, and you may have come to the point in your career where you simply want to go into your employer's office and say, please fill in the retirement papers. I've had enough, I want to retire, and that's it. From a superannuation point of view, you can do that. So this is different from the Centrelink age pension, which doesn't kick in until at least your mid-60s. But from a superannuation point of view, you can start to access super at the moment from age 58. Now, if you do that, there may be some tax implications before age 60, and that's when things start to become a bit more interesting. So from age 60, if you terminate an employment arrangement, then you can have, in fact, you can have full access to your super. And if you had a transition to retirement pension from age 60 onwards, then whatever money you receive from that transition to retirement pension would be tax-free. And the third bucket, from 65 onwards, even if you're working full-time, you have full access to your super, whether it's in pension phase or as a lump sum. And as we saw on the previous slide, there is no tax on the earnings from age 65. So those are the three different stages for funding your retirement. So if we just go back a step, sorry, I tricked you there, didn't I?
Yep.
Yeah. So what I meant to say is, if we look at the accumulation phase, why might we consider salary sacrificing into superannuation? So on this slide, we can see the different tax brackets and the different tax rates. So if we look at the third bracket, which is $45,000 and above, you'll see that the marginal tax rate is 32.5%. So what that means is that for every dollar that you receive as take-home pay, you are paying 32.5%. Now, if we remember, sorry, if you were to salary sacrifice that money into super, you would be paying a contributions tax of 15%. So you can see that there is already a distinct advantage in the tax applied to those at that rate. And the more you earn, the bigger the tax advantage between the marginal tax rate and the 15% that you pay as contributions tax. Thank you. So just to give you a very simple example, I've been led to believe that this is for a person who is earning $100,000. And we can see in the first column, which is in fact the middle column, that this person has elected not to make any additional contributions. So it's simply their taxable income coming off the gross amount, and their take-home pay is just under $2,900 a fortnight. In the right-hand column, we can see that this person has elected to have 5% of their salary sacrificed to superannuation. So that comes to $192 per fortnight. What that effectively means is that their taxable income has reduced from 3,846 to 3,653. And interestingly enough, the take-home pay is not that different. So there is a difference of $127, but bear in mind that $192 has been added to that person's superannuation account. So in a very simple sense, that's how salary sacrifice contributions to super works. So continuing on that theme, salary sacrifice contributions are what are known as concessional contributions. Superannuation, unfortunately, has a lot of jargon, so I hope we don't confuse you too much, but concessional contributions means all of those contributions on the left-hand side, i.e. your normal employer contributions, which could be superannuation guarantee, any salary sacrifice contributions, and the last one there is personal deductible contributions, which I will talk about a bit later. The contribution cap has risen from 25,000 to 27,500 each financial year, and this started in July of this year. So we're already 3 months in to the new concessional contribution cap regime, and the sorry, just go back a second. Bearing in mind that there is a 15% contributions tax for each of those contributions listed on the left-hand side. Thank you. Right, so we were talking about concessional contributions a second ago, which are pre-tax contributions. I'll now mention non-concessional contributions, which in English means after-tax contributions. And the limits for for these have also changed from July of this year. So the annual amount for anybody under the age of 67 has risen from 100,000 to 110,000 per annum. Now, the interesting thing is that if you have not used up your limits previously, you can bring forward 3 years of that non-concessional contribution limit and effectively put in 330,000 in one go. If you were to do that, then for the next 2 years, you would not be able to put in any more non-concessional contributions into your account. Recently, the government has also changed the eligibility for people aged between 67 and 74. So if you are in that age bracket, you can contribute that up to $110,000, but a work test does apply. A work test means that if you are asked, and presumably by the tax office, you would have to demonstrate that you have worked 40 hours in a 30-day period at any stage within the financial year in which you are making that contribution. And then from age 75 and over, there are no further personal contributions which can go into super. However, if you're still working, your employer is still obliged to pay what is now the 10% on your earnings at whatever age. Thank you. All right, so I've just mentioned if you like, the traditional ways of making contributions to your super. Listed here are 3 other ways. Downsizer. So currently, if you are age 65 or older and have lived in your principal residence for at least 10 years and are considering downsizing, i.e. selling your house, you can put in per person $300,000 basically of after-tax contributions into your super. And this is over and above the limits which I showed you on the previous slide. From next year, the age of the eligibility for the downsizer contribution is reducing to age 60 with the same other conditions which I mentioned. Spouse contributions, this is where your spouse or you, on behalf of your spouse, can put in up to $3,000 and get a tax rebate on that contribution. And finally, consolidation is simply bringing together any other superannuation funds which you may have in your name and bringing them into one account. Thank you.
Right.
I will now pass over to Jolene.
Thank you for that, John. We have had a couple of questions come through. We are going to have a bit of a bigger question session at the end, but there's a couple of quick questions that we've had that while we're on those slides, we'll just cover them off very quickly. And that is, does the 15% tax and also the cap of 27.5, does that include employer contributions? Yes, it does. Okay. Non-concessional contributions, there is no tax on entry. So with those ones, if you've got 100,000 in the bank and you put 100,000 in super, 100,000 is what is added to your super. No additional tax is taken out on that one. But we will come back to some of those questions in the question and answer session at the end, because they might just be a bit meatier and a bit more interesting for everybody. So do send them in, and if we don't answer them straight away, don't get concerned, we will come back to them. So when you do get to the point, remembering those 3 age buckets that John spoke about, you've got the option of starting to use your super. So it could be for retirement, it could be for some pre-retirement planning as well. And depending on which age bucket and which box you've ticked to access your super, you may be able to access lump sums, you may be able to access income streams, or both. So your super account, this is for your working life. So this is where you are funneling all of your savings, all your employer savings while you're sitting there, okay? Earnings are taxed up to 15%, and a transition to retirement is taxed up to 15% as well. When you do hit one of those points where either age 65 or retirement or change employer, and you're allowed to start a retirement pension account, those accounts allow both income, regular, as well as those ad hoc lump sums, and the earnings are tax-free. So you work hard to put money in and you start your pension, and then you get to withdraw it. You get to have fun with it. There is a rebate for 58 to 59. So it's not, you're paying your marginal tax rate. It's not like regular income. You do get a 15% for the fact that it's paid that during its account life. But from age 60, and this is when we see most of our inquiries, it's because people can get their super tax-free. So whatever withdrawal you take from age 60, whether it's income or lump sum, it will be free. Tax-free, that is. I shouldn't say free. When you do go to withdraw, there are still a couple of rules, okay? The minimum withdrawal is 2% to 7%, depending on your age for this financial year. In response to COVID, the government has reduced these minimum withdrawals. So normally it would be 4 to 14%, but this financial year they've reduced it. It is 2 to 7%. And there is no maximum withdrawal on a retirement pension. If you have a transition to retirement, you are only allowed 10% per financial year. So if you've got 300,000 in your transition to retirement pension, then you're allowed 30,000 as your withdrawal. When you do start a pension account, whether it's a transition to retirement or whether it's the retirement pension, you have a choice of 2 different types of retirement products. The first one is Retire Choice, and the big clue is in the name. It gives you investment choice. So you decide where you want to have your super invested. You decide where you want to take your payments from. So you can choose a pre-designed portfolio, so shares, growth, capital stable, socially responsible is getting more and more popular as well. And you can also choose single assets. So if you particularly like shares, you can choose between Australian or international shares. You can also choose, cash and term deposits. So what that means is you can mix and match with these options. So people may choose that, okay, I've got a mix of 2 options or 3 options. I'm going to choose out of my options, I'll have a little bit in cash, and that's where I want my payments to come from. So that's where you've got choice. You choose where you're investing, but you also choose where your payments are taken from. And when the money in that choice runs out, well, then you choose where they get paid from next, or they will automatically be drawn proportionally from whatever is left. The other retirement pension product you can choose is called Retire Smart. So this is pre-designed, which means that when you go into it, you're giving up that choice of which investment option you want, where do I draw it down from. It's fully designed to make that automatically for you. Okay, its focus is on generating a consistency with its income for as long as possible, and it does that by investing in 2 buckets. So it has growth assets, it has cash, and your pension payments always come from the cash option. So there's money transferred into the cash option to make your pension payments, so you're not having to choose which bucket your payment is coming from. That will happen automatically for you. Now, with this option, the growth assets tends to be a little bit higher in growth assets. So sometimes when people say, oh, I like the idea, but maybe I want a little bit of growth, or a little bit less growth, then they're looking at the retire choice option. Okay, so just remember, this one does a very good job. It makes it very easy. You don't have to worry about the choices. It makes all of those for you. But if you do want choice, then it's the other one. All right. So longevity, the biggest questions we have is, how long will my money last? The answer to that is, well, two things. One, how much do you have, and how much are you going to spend? Because that will tell us how long your money is going to last, and how long do you want it to last for as well. Okay. So COVID, oh, I better touch on COVID. Bless it, it hasn't gone away yet. COVID is just another financial impact. So we had the GFC and we've had COVID, and you can also replace it a little bit with something a bit more personal, such as the roof caved in and all of a sudden you've got to spend money. So when we're looking at retirement planning and we're looking at longevity, we're also looking at, well, what are the what if scenarios? So whether it's an external scenario, such as a big event like COVID that impacts on the investment side of things for you, or whether it's a personal event, they do have the same impact. You've ended up taking a little bit of a hit to your retirement savings. So when you're having a look at things like that, we sometimes get people coming back to us saying, you know what, something unexpected has happened. I want to check in because I was on track, but now I'm not so sure. So we can help with that as well. So I'm going to give you a bit of an example. I mentioned before that we were going to have a look at how the age pension and super can work together, but also stack it up against those lifestyles that we spoke about. So as a couple, to have that comfortable lifestyle, you typically would need 640,000 in savings behind yourself. Now, for a comfortable lifestyle for a single person, it's actually not a lot less. It's 545,000. And that's because you've still got those standard bills, you've still got the rates, you've still got the utilities, you've still got rent. So these figures are based on you owning your own home. If you are renting, you will need a larger lump sum. Okay. But this example, we've got a couple, they have 300,000 each. So they've got 600,000 in total. They're 65, they want to retire. They're not yet age pension age. So they've got to start by using their super. And that's all they've got. They've nice and simple. They've got the age pension and they've got super, and they've got 600,000 in super. So they retire at 65. And this is how long they're projected to have 63,000 for. It eventually does run out in their mid-90s. Okay. This is the one that we get more interest from. It shows us where the money is coming from. So as you can see, purple is your superannuation. The red line is the cost of living. And whenever we help people with projections, it is indexed for CPI as well. So it's whatever that target of 63 is buying now, in 5 or 10 years, they're still being able to buy that, even though it will cost them a little bit more. So the first year of retirement, they're not yet age pension age, so all of their income is coming from their super. Second year of retirement, partway through, 65 and a half, they start receiving some age pension. It goes up the following year and it increases slowly up to the maximum. So it provides that baseline for their expenses, and superannuation provides the additional amount on top of that. Age pension eligibility, birthday, residence, asset and income, and we're going to have a look at the asset and income test a little bit more detail as well, because everybody gets tested against both. And then the Centrelink gets the results for you and they say, okay, well, out of the age pension, out of the asset test, out of the income test, which one gives you the smallest amount of age pension, That's the one that determines your payment rate. So check your birthdays. These are your age pension age currently. Okay. For a lot of us, we'll be waiting to 67, and this is why John was quite strong on the point. 65 for super, 67 for age pension. They are not one and the same. So the asset test, with both asset and income test, it's a sliding scale. So if you have an amount under a certain limit, you get the full age pension. If you're in between, you get a part pension, decreasing the more savings you have behind yourself. And these figures are all for 20 September, so they get updated every quarter. Okay. For couples, as you can see, a little bit more, and you can see the trend that non-homeowners, you get more of an allowance under the testing because you need more. You'll be paying rent, and rent does fluctuate. So there is recognition within Centrelink's testing that you do need more resources behind you as well. Now, the income test, okay, when we're looking at income, the way Centrelink assesses asset and income, most people know that under the asset test, your home isn't counted. A lot of other things are, okay? So, for example, I had someone just ask me today, oh, but the bank account's in my wife's name. It's like, yeah, but you've got full access to the bank account. So the bank account's counted. But the wife's a wee bit younger, her super may or may not be counted depending on her age, okay? With income, it's income that you earn. So yes, it is. If you're doing casual work or if you're still working, it counts. If your age pension age and your spouse is still working, their income counts. But there's also deemed income. So this is the phrase Centrelink uses for what they assume that you're earning. So they'll take your super, they'll take your cash in the bank, and they'll say, this is your little pot that you have. We're going to assume you get a certain interest rate on that, and we're going to add that interest to your income. So the income they assess, yes, it is money that you earn, but it's also assumed interest on your financial assets as well. Okay, so they combine that, and again, they have their sliding scale. But as you can see, if one person's still working, but they're doing part-time or casual work, for a couple, if that income is under 84,000, the non-working spouse could still get the age pension. And a single person, it's not saying you have to be fully retired. Quite common with teachers doing relief work, they're still getting the age pension because they're not doing full-time work or they're not doing permanent part-time. The most that you will receive, 25,000 for a single or 25,000 each for a couple if they can't live together due to ill health, and almost 38,000 for a couple. So that is quite a gap from that comfortable lifestyle target, okay? So the age pension provides a very good base, but most people want a little bit more than that because it's quite hard on just the age pension. Other things that will help you in retirement, okay? WA Seniors Card kicks in at 62. Commonwealth Seniors Card kicks in when you are age pension age, but when you don't receive the age pension because of the asset test. The income test still applies. So single couple, income under 57,000, and a couple, income under 92,000. So it is possible that if assets knock you out, income, if you still meet that, you might still be able to get that seniors healthcare card, which can be quite helpful. If you are joining us from anywhere outside of WA, please also check your own state and territory. This kicks in earlier, so you can start picking up a few discounts earlier than the Commonwealth Seniors Card or the age pension card, okay? There is a fair bit of overlap once you get into the bracket where you can potentially have more than one card, but they're not exactly the same, okay? So do check what discounts apply from your state government. In WA, for example, we have a fuel card for people who live in rural areas, which is another benefit That's just for WA seniors. Estate planning. Please let us know if you need a referral. Please let us know if we can help you with a discussion on what might be important or relevant to you. We are not solicitors, but we certainly will have a referral point for you, and we certainly will give you some food for thought to start thinking about those things. It's not just the will, it's not just nominating the beneficiaries, there's power of attorney, there's guardianship, there's advanced health directive. So get your wishes down, make it nice and clear what you want to happen and who you want to help take care of your business as well. Aged care. I'm starting to hear a lot more about the sandwich generation. So those of you in their 50s and 60s that perhaps still have elderly parents and have some kids that have boomeranged back home. So you've got dual responsibilities and you're kind of being sandwiched in the middle. We do provide advice with aged care, and we do have a fair bit of information on that to try and help people. So it may not be just for yourself and future planning for yourself. It could also be because you're taking care of others. There's a lot of help and resources out there. So not just us, but other areas as well. But please let us know how we can help. And back over to yourself, John.
Thank you. So Jolene has already raised a few things in her presentation which you may consider you need financial advice, personal financial advice for this. Some of the others which are quite common are saving you money on your retirement. A big one is the second one, help maximise Centrelink. That is a minefield all of its own, and I defy anybody to understand all the rules and regulations from Centrelink. Jolene already mentioned about longevity and how long your money will last in retirement. So there are tools which we can help in that regard. Looking at all your goals, short, medium and long term. We just talked about estate planning and the myriad of options involved with that. And Jolene can also advise on your non-super investments. So it's not just super itself, there's a whole bunch of different areas which she can help you with. So that leads on to what types of financial advice do we offer in the fund. So I've just talked about comprehensive advice, which Jolene can help you with. The other two, starting with over the phone, and this is a really very common and well sought after area of advice at the moment because of member investment choice. If you have questions that you want answered about either member investment choice or the different types of contributions or insurance within super, then I would encourage you to make a booking through the fund to speak with one of our limited advice colleagues who will be able to help you with that and send you a written statement of advice, which you can then either act upon or just keep for general reference. But over the phone advice is free. The only cost to you is your time. So generally an appointment over the phone can take half an hour or so. Very, very worthwhile in this current climate. I should just mention about the comprehensive again. Often we get questions as to how much a comprehensive financial plan will cost. My understanding is that it is based on the scope of the advice given. So it could range from, let's say, $1,000 to maybe $3,000. So I believe that the average cost of advice through the fund last year was about $1,700. So that's just to give you some idea, but a full quote will be given to you when you sit down with Jolene and have the first initial meeting. That full quote will be given to you, and then it's up to you as to whether you proceed with the advice or say thank you very much, but no thank you. So you're not locked into it from the very beginning, but that's how that works. And with the general advice, so I am able to give general advice. Just to give you an example, today I was driving up and down the Southwest Highway, talking to principals and staff at the 3 primary schools along there. Again, that comes at no cost to the individual, and I am able to give factual general advice to individuals and groups. So those are our financial advice offerings. All right. So superannuation comes with a lot of legislation, and the government takes a great interest in superannuation. So I'm going to preface the start of the comments I'm going to make for the next few slides in that if you are a pension account member, then none of this has any interest to you. And also, if you are in the superannuation fund and have exercised member investment choice, then again, this section is of no interest to you currently. So in October of last year, the government introduced through the budget a performance test, and this has come into effect from July of this year. So it's all very new. This is the first time that it has come into existence, and at the end of last month, Australian Catholic Super was informed that our default MySuper investment option did not pass the test. Not the whole fund, only the default investment option. Okay, I can. Okay, so the way the government has done it is by looking at performance over a 7-year period. I'm not sure why they chose 7 years, but that's what came out. And unfortunately for us, our MySuper investment option has only been going for 3 years. So already the performance test, in my opinion, is flawed. So what the government has done has tacked on the previous 4 years performance of our previous conservative balanced option. So the combination of these two did not pass the mandated test. So as I mentioned, this is only to do with the MySuper option and does not cover the other 13 choice products. This test will come in next year for the choice products. And to date, we haven't been notified of where we actually ranked in the position for the benchmark. So we may have missed it by a very small margin. We don't know. Okay. One more. Okay. So in the media, you may have read various comments and articles by journalists. And as I said, a lot of these comments feel that the performance test is flawed. There is a lot of information on our website. Now, anybody who has received an email or a letter, and I believe they've gone out today, in fact, I received one myself today, will be encouraged to go to the ATO comparison tool, which is online, and to compare this fund with any other MySuper product which is out there in the market. So your choices from that are to either change fund or change your investment option within Australian Catholic Super, or to ignore all the correspondence to do with it and stay with the MySuper product in Australian Catholic Super. So those are your three choices. Okay. So in the last week or two, if you are in the accumulation stage of the super fund, you would have received your annual statement. And here on the screen, you can see the performance for our MySuper product, which is lifetime one. And you will see that the returns for the 12 months to end of June 2021 are really quite exceptional. So, and you can also see the 3-year returns to the end of June 2021. So as I said, our MySuper product has only been in existence for 3 years, and the investment performance over those 3 years has been very good. So please take that into consideration if you have received a letter from us today. So the trustee has a clear strategy going forward. And in fact, the reason why we changed from the previous default option to the life cycle option was to ensure that members' best interests were being followed. We continue to work closely with the Catholic Education Office and many Catholic agencies. But if you do have any concerns, please contact either myself or your regional manager, wherever you may be. So as a member of the Superannuation Fund or as a pension account member, excuse me, you have access to the member portal online. So I do encourage you, if you haven't already, to register for access to the member portal. And if we move on there you can see the many different functions which are available on the member portal. So if you're, you can see your account balance or change your investment options. If you have an insurance in there, you can see that and also apply for more insurance if you wish. You can nominate a non-binding beneficiary on the portal. If you want to either review or complete a binding nomination, you will have to do that on the paper version and have 2 witnesses to your signature. So please be aware that if you do that, all the dates on the form are the same, i.e. the date that you sign the form and also the date that the 2 witnesses sign that form. So many things are available on the member portal, and I recommend that to you. So finally, we have the contact details here. You can contact us on the 1300 number, or via the website, or via email. So thank you for that. We have enjoyed your attendance today, and I'll pass you over to Justin.
Thanks, John and Jolene, for a very informative webinar tonight. We have a number of questions that have come through so far. I'm just looking onto my other screen here to monitor them, they're still coming in. I know Jolene's been busy typing away some answers there, but Jolene, they're only coming to me, not to the actual person who asked the question. So I'm going to read the questions out and you'll have to go through your answers to the members. So the first one was, so the concessional contribution cap includes regular employer contributions. Is that right?
It does. So the concessional contribution cap includes any contribution that has a lower tax rate. So that is your employer contributions, that is your salary sacrifice, that is any contribution that you are claiming a tax deduction for. They are all under that one cap of 27.5.
Great, thanks, Jolene. We actually had a member early on say that they're having trouble seeing the slides. Hopefully no one else experienced that, but I logged on myself as an individual and I had no issue. I also looked on Facebook where we were streaming it live and it was all coming through. So hopefully nobody else had any issues there. The next question was downsizes. Do both spouses have to be age 60 plus? I'm 8 years younger than my husband. Jolene was nodding or shaking?
No. With the downsizer contribution, it is targeting a certain age bracket in case there wasn't other avenues for them to get the money in. So to be clear though, if you're looking at two spouses, one is in the age bracket, they can make a downsizer and the other one isn't. What that means is the spouse that isn't in the age bracket for the downsizer contribution can't make it. They can make normal voluntary contributions, so non-concessional. The spouse who is in the age bracket can make the downsizer contribution. So just because one half of the spouse can't because of age, doesn't rule out the older spouse.
Great, thanks, Jolene. The next question I have here is, how do I make an appointment to see an advisor? I'll let Jolene answer that, but what I'll also just say, John spoke about the 3 levels of advice the Australian Catholic Super offer. And you'll notice in your chat box, there is a link that I did send through a link. If you just put in your personal details in that link, someone from the office will contact you to book that appointment in. And I'll also be sending out a survey after this webinar tonight. And there's also in the survey, if you want to be followed up for advice, there's a question there as well. Did you want to add to that, Jolene?
Just at this time, let us know you want us to contact you. Our call centre is a little bit busy, so you can call the 1300 number at any point in the future and be put through to make an appointment. But right now, because you're on the seminar tonight, if you want an appointment, fill in that feedback because we'll get back to you much faster.
Definitely the case. The next one is that they said, I'm 71 and may soon receive a large lump sum, redundancy and long service leave. I currently sacrifice the maximum amount. Can I deposit a lump sum as non-concessional contributions or as a non-concessional contribution?
In the year that you are still working, yes. So the work test applies. So for example, we're at the start of the new financial year. So you've got until 30 June to get that lump sum in. But after that point, new financial year, no. So it's got to be in the financial year that you've met that work test, and you've got to meet the work test first, then make the contribution, and the maximum non-concessional is 110.
Great, thanks, Jolene. The next one is, can you remind me of the difference between binding and non-binding beneficiary?
Okay, I'll have a crack at this one. So if you make a non-binding nomination, then essentially you're giving your instructions to the fund as to who you would like your super paid in the event of your death. However, the trustee is not bound by that instruction. If you choose a binding nomination, as the word suggests, the trustee is bound to pay the super as you have instructed, so long as the person or persons are eligible on that nomination.
Thanks, John. The next one is, I know Jolene touched on this earlier on, but I'll just repeat it because a few people did join after this question. What is the tax on non-concessional payments?
And there is no tax. So if you've got 10,000 in the bank and you want to put 10,000 in your super, transferred from the bank or bank check, then 10,000 goes in your super and there is no tax on entry. And it also means that money, there is no tax on exit at any point in time.
Okay, great. Jolene, another one which you touched on as well, but what is the difference between contributing 10,000 through salary sacrifice and making a 10,000 lump sum out of your savings?
So with 10,000 from your savings account, okay, when it goes in, it doesn't pay tax, so you keep the full 10,000. On exit, at any point, whether you, your spouse, or your adult children inherit that money, on that 10,000, there's no tax on exit, okay? When it is invested, it goes into your normal investment options. Salary sacrifice, when it goes into your super, it comes from your pre-tax money. So that means it hasn't yet been taxed by the ATO. So the 10,000 goes in and it pays 15% contribution tax. Now, as John's example showed, if you're still earning income and you're normally paying 32.5%, then the 15% on the salary sacrifice is a nice option because it's cheaper. Okay, you're not paying as much tax. So the difference between the money in the bank is you've already paid 32.5 on it. So when it goes into super, it doesn't pay extra because it's a voluntary contribution, whereas salary sacrifice comes from before you pay tax, before it's sitting in your bank account, and it pays 15 on entry until instead of your normal marginal tax rate. Okay, on exit, that money that you've salary sacrificed, if you're under 60, there are tax implications, and there are tax implications if your children inherit it. So the difference is how it's treated on entry and how it's treated on exit, and depending on your situation, one might be slightly more beneficial to you than the other.
Right, thanks, Jolene. The next question I've got is, just to confirm, I'm working full time. If I turn 66 at the start of next year, can I make a non-concessional deposit into my super, e.g. 10,000, the year after in January 23? I turn 67. Can I add to my super up until June?
No. So that one is dependent on your actual birthday. So if your birthday is the 26th of January, for example, you can put money in on the 25th of January, but once you turn 67, you've got to meet that work test to put money in after your birthday. So if you've already worked that year, you're great, but if you've done no work that year, then you need to make the work test after you turn 67 to put that money in.
Great, thanks, Jolene. We've still got 2 questions to answer, but they're short ones, I think, so that's good. But just anybody out there who has any questions, please start typing away. Otherwise, we'll be wrapping up after the next 2 questions, and we'll get back to you tomorrow, anybody who asks questions after that. So the next one is, for the family home that's not including assets, what if you have a rural property like 25 acres or above?
Oh, Justin, I love that you think this is going to be a short answer. All right. This is a Centrelink question. So I'm going to try and hit the key points for you. Okay. When you have a large land, okay, so 25 acres and above, the first 2 hectares that your primary home sits on a single title is exempt. Okay. That's called curtilage. So it's the primary home, 2 hectares around it. The rest of the land may or may not have special rules applied under what's called an extended land use test. So some of the key things there are, if someone's been working the land for 20 or more years, if it's not directly yourself who owns the land, but it's your niece or nephew that's continuing to work it, those family situations are taken into account as well. And the extended land use test looks at, can you generate an income from that land? Because there are some beautiful spots out there that are rock, stone and gorgeous. And you know what? You're not going to be able to farm anything on those. So the answer to your question is, you've got a little bit around your house that is exempt. The residual has special rules applied to it. And if you are a farming family, there is more likelihood that the special rules will be beneficial. If it's something that has only recently been purchased, it's unlikely that those rules will be beneficial. Please contact Centrelink for details about your particular property and use.
Great. Well, I should clarify something, Jolene. I only looked at the question. I didn't actually proofread it beforehand. And some of the questions are coming in 3 and 4 lines for each question. Those 2 questions were one-liners, so I thought they might be quick. But since I put the call out about last questions, we've got a couple more that have come in. So the next one is, and I'm not going to proofread them. I am going to read all the questions out and not vet them, even though it's 9 o'clock over here in Sydney for me, and it's only 7 o'clock for you guys. But if I work full time until I am 70, can I still be adding in 27,000 or 27,500 a year?
Yes, you can. That's my nice short answer. Justin, did I do better on that one?
Oh, lovely. Thanks, Jolene. Then another question is, why bother non-concessional? What's the advantages over just leaving the money and, say, investing in shares outside of super?
Tax rate. If you invest the money in shares outside of super and you are working full time, whatever earnings you're making on your shares, you will be taxed at your marginal tax rate. Yes, you get franking dividends, which helps with that, but it is your marginal tax rate. Whereas investing in shares within super is only taxed up to a maximum of 15%. Another advantage of, because you focus on the advantage of outside of super, access. Okay, if you're looking at building wealth outside of super, well, you've got access to it, whereas inside of super, it is for the long term. So even though you get that great tax rate on the earnings that you make, there are more rules around getting at it. So again, there are always advantages to both, but there's also disadvantages depending on your goals.
Great. And I think probably the other thing is that you've got to have time to invest in shares and know what to look for and do your own research and things like that, where superannuation funds have investment teams and fund managers out there doing the research for us. So that's another good thing there. John, you spoke earlier or answered a question about binding and non-binding beneficiaries. This one is quite simple. Which one is better?
Well, how long do we have? If you have a binding nomination, then, as I mentioned earlier, the trustee is bound to make that payment as you have instructed. And from experience, I have noticed that the payment to the intended beneficiary is a lot quicker if it is a binding nomination.
Thanks, John. That is the last of the questions that we've had. So thank you. I'll drop back out now and let Jolene and John wrap things up. And thank you, everybody. And you'll be receiving a survey from me later on this evening. So please complete that and we'll get back to you. Thank you.
All right. Thank you very much, Justin, and appreciate that we have eaten into your evening over there in Sydney. It's now 9:05. Thank you everybody for attending this evening. I hope you have found it of interest and that you have learned something. As Justin mentioned, he'll be sending a link, and so if you want any further information, please complete the survey and we'll get back to you as soon as possible. In the meantime, thank you very much again, and please stay safe. Good evening.
Thank you. Mark, you just sent through a last minute, I'm not sure if it's query or a statement. Let us know. We can get back to you outside of the seminar as well. So on that feedback, if you could give us more details about what you're looking at with that, we can definitely get back to you with that as well. And thank you everybody for your time this evening. You all stay safe and have a lovely week.